Welcome to our 2016 year-end report. Well, you know you're deep into a long-standing bull market when you see things like average pedestrians keeping one eye on the market tickers outside of brokerage houses to see when the Dow Jones Industrial Average has finally breached the 20,000 mark. Who would have imagined record market highs at this point last year when the indices indicated the year in negative territory, remember? When 2016 got off to such a rocky start, tumbling 10% in the first 2 weeks? The worst start to a year since 1930? The markets eventually bottomed in mid-February and began a long, slow recovery, turning positive by the end of March, suffering a setback when the UK decided to leave the Eurozone in June and endured another hard bump right after the elections. In the end, we were kind of disappointed. The Dow finished at 19,762.6 for the year. But the bull market has continued for another year. This was the second year in a row that the final quarter provided investors with solid gains. The Wilshire 5000, which is the broadest measure of U.S. stocks, was up 4.54% in the fourth quarter of 2016 alone, ending the year up 13.37%. Pretty good performance. Large cap stocks were up as well. The Russell 1000 large cap index closed with a 3.83% fourth quarter performance and finished the year up 12.05%, while the widely quoted S&P 500, which is an index of the 500 largest companies in the U.S., was up 3.25% in the final quarter, finishing up 9.54% for the calendar year 2016. The Wilshire U.S. Mid-Cap Index gained 5.3 in the final quarter and finished up 17.22%, showing that the mid-caps definitely did better than the large caps. The Russell mid-cap was up 3.21 in the fourth quarter, was up 13.8 in the calendar year. But the area that really shone was the small company stocks. The Russell 2000 small cap index finished the year up 21.31, while the technology heavy NASDAQ composite index rose just 1.34% in the fourth quarter to finish the year up 7.5%. International investments contributed a slight decline to overall portfolio returns. The broad-based EFA index of companies in developed foreign economies lost just a little over 1% in the fourth quarter of the year, finishing the year down 1.88% in dollar terms. In aggregate, European stocks lost 3.39% for the year, while the EFA's Far East Index gained was almost flat, 0.14%. Emerging markets of less developed countries, as represented by the EFA EM Index, actually gained 8.5% for the year. So again, we see a lot of diversity in returns, even within stocks. Our primary stock fund, the DFA Selectively Hedged Global Equity, returned 12.84% for the year. Pretty respectable. Looking over other investment categories, real estate investments, as measured by the Wilshire U.S. REIT Index, lost 2.28% during the year's final quarter, but still managed to finish up 7.25% for calendar year 2016. Our global REIT fund, the DFA Global Real Estate Securities, returned 6.56% in 2016. So that was a little bit less than the U.S. return, but remember, our REIT fund is global, reflecting some of the negative returns global-wide, but still very respectable. Last year, investors were wondering why they even own commodities in their portfolios when their statements showed that the index delivered a whopping 32.86% loss. This year, they may be wondering why they weren't more committed to commodities, as the S&P GSCI index gained 27.77%. That was fueled in part by a 45% rise in the S&P crude oil index. Gold prices shot up 8.5% for the year, and silver gained just under 16%. Our main commodity fund, DFA Commodity Strategy Portfolio, rallied from 2015 lows, similar to the indexes, and ended the year with a 13.77% gain. Our investment strategies performed in a mixed fashion. The absolute return category, which has the AQR style premium alternative fund, finished down 0.5%, while Ironclad Managed Risk Fund was up just under 2% in 2016. Our Managed Futures Fund, Stebbin Managed Futures Strategy Fund, finished up 5.86% and performed strongly at the beginning of the year, which is important when the stock markets dropped that 10% in 2 weeks, and performed really well in the days after the Brexit vote. So in doing that, it really filled its role as a volatility dampener, and we were really pleased to see that. In the bond markets, it's possible that the decades-long bull market, which basically means declining interest rates, has ended, because the fixed income world is experiencing rising interest rates. But despite the nudge by the Federal Reserve Board, the moves here haven't exactly been dramatic. Over the past year, rates on 10-year Treasury bonds have risen from 2.25% to just under 2.5%, while 30-year government bond yields have barely risen from 3% to 3.07%. According to Barclays Bank Indexes, U.S. liquid corporate bonds with a 1 to 5 year maturity have seen yields rise incrementally from 2.4 to 2.8% on the average. In the high-quality bond space, 2 of our funds finished positive, which are the only 2 we use. The DFA Selectively Hedged Global Fixed Income was up 3.27%, and the DFA Investment Grade was up 2.57%. Our inflation-protected bond fund, the DFA Inflation-Protected Securities, finished up 4.67% for the year. And we also saw high-yield bonds recover from a pretty lackluster 2015 by returning 15.05% in 2016. High-yield bonds ended up being our number 1 highest performing asset class in our client portfolios. As always, there were many unpredictable anomalies in the investment world in 2016. In the international markets, and you were lucky enough to have speculated on the Brazilian Bovespa index, which is comparable to our S&P 500, would have reaped the gain of 68.9% this year. That's despite all the headline drama around the Zika virus and political uncertainties that were reported during the Olympic Games. Russian stocks, they were up 51% for the year, despite the recent sanctions from the U.S. government and the lingering international sanctions related to the invasion of the Crimean Peninsula. So what's going to happen in 2017? The short-term market traders seem to be expecting a robust economy stimulus combined with lower taxes and deregulatory policies that would boost the short-term profit of American corporations. But it's helpful to remember that we're entering the 9th year of an economic expansion, making this the 4th longest since 1900. That's in over about 125 years. In addition, growth has not exactly been robust. The US GDP has averaged just 2.1% yearly increases since the Great Recession in 2008, making this the most sluggish of all post-World War II expansions. And I think something to keep in mind was that the Great Recession was not a recession at all, but it was a financial crisis. And it typically takes 6 to 10 years to recover from a financial crisis. So that's why it's, in my opinion, been so slow going. But slow and steady hasn't been a terrible formula for workers or stock investors. The unemployment rate has slowly ticked down from a post-recession peak of 10% to less than 5% currently. That's good news. U.S. stock indices are posting record highs with double-digit gains, and that Dow 20,000 level, while essentially really meaningless, is still catching a lot of attention. It's clear that the new president-elect wants to accelerate America's economic growth, but the policy prescription hasn't always been clear. We will have to see if we're going to rip up long-standing trade agreements, cut back on immigration quotas, and deport millions of workers across the borders without a visa. Will there be a wall built between the U.S. and Mexico? Will the government pay for huge infrastructure projects at the same time reducing taxes and thus raising the national debt? Will Congress raise the debt ceiling without protest if that happens? Will the feds raise rates more aggressively in the coming year, or cooperate with the president-elect in his efforts to drive the economy into a faster lane? Will tariffs be increased from, say, an average of 1 or 2% to 35 or even 45%? There are just many unknowns around the globe, too. China's economic growth is stalled for the second consecutive year, and you'll soon be reading about a banking crisis in Italy that could force the country to leave the Eurozone, potentially a much bigger blow to European economic unity than Brexit or even a possible Greek exit. Russian hackers may have ushered in an era of unfettered global intrusions into our intranet infrastructure, and there will surely be a continuation of ISIS-sponsored terrorism in certainly Europe and elsewhere. Every year of this long-standing bull market, we have to look over our shoulders and wonder when and how will it end. With the January downturn and so much uncertainty at this time last year, nobody could have predicted double-digit returns on U.S. stocks at year-end. Next year could bring more of the same, or it could fulfill the dire predictions many have made during the election cycle, including both Democrats and Republicans, who believe the country is in worse shape than the numbers would indicate. What we've learned over the past few years is that the markets have a way of surprising us, and that trying to time the market and get out in anticipation of a downturn doesn't work. That is a loser's game. At the county fair, when we get on the roller coaster, we don't bail out and jump over the side at some scary point on the track. We hang on for the ride. The history of the markets has been a general upward trend that benefits long-term investors. And looking out over the long term, that and a few hard bumps along the way is probably the best outcome to expect. Thanks for joining me.